consumers.
So if oil prices jump, it costs more to transport everything, and then my milk becomes more expensive because it costs more for the dairy farm to get it to the grocery store.
Precisely. Global supply chain disruptions, energy price spikes, and even geopolitical events can all contribute to cost-push inflation.
How do they actually measure this stuff? Is there like an inflation meter somewhere?
Not quite an inflation meter, but the most commonly cited measure is the Consumer Price Index, or CPI. This tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services.
So they look at a basket of things like groceries, gas, rent.
Exactly. It's a comprehensive list: food, housing, apparel, transportation, medical care, education, recreation, and more. The Bureau of Labor Statistics collects price data on thousands of items to compile it.
But does it really capture my experience? My spending habits might be different from the average urban consumer.
That's a great starting point, Sarah, and those are certainly very visible symptoms. At its core, inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. Think of it this way. What $100 could buy you a year ago, it can buy you less of today.
Okay. So now I understand what it is and how it's measured. But how does inflation really affect me? Beyond just my grocery bill. And what about my savings and investments?
Great question, Sarah. For everyday life, beyond the direct hit to purchasing power, inflation can erode the value of your savings. If your savings account is earning 1% interest, but inflation is at 5%, you're effectively losing 4% of your money's value each year.
Those are really tangible tips. Alex, I know I'm definitely going to be looking at my budget more closely after this conversation.
Generally, yes. It's why people often look to investments that can outpace inflation. For investments, inflation impacts different asset classes differently. Fixed income investments like bonds, especially long-term ones, can be particularly vulnerable because their future payouts are fixed, but the purchasing power of those payouts declines. It's more nuanced. In the short term, high inflation can create volatility and uncertainty, which can hurt stock prices. However, many companies can pass on higher costs to consumers, maintaining their profit margins. Historically, over the long run, equities have generally provided a reasonable hedge against inflation, but it's not a guarantee, and sector selection matters. Companies with strong pricing power tend to fare better. Real estate can also be a good inflation hedge, as property values and rents often rise with inflation.
So, who's responsible for managing this? And what can be done about it? So, if it's harder to get a loan for a house or a car, people buy less. And that cools down prices.
Exactly. It's about reducing that demand pull pressure. They can also engage in quantitative tightening, essentially reducing the money supply. On the flip side, if inflation is too low or the economy is slowing, they might lower interest rates to stimulate spending.
We've seen a lot of interest rate hikes recently. What does that tell us about the current inflation picture?
It indicates that central banks around the world have been aggressively trying to bring inflation back down to their target levels, typically around 2%. Predicting what's next is always challenging, but many economists are watching for signs that these rate hikes are truly having their intended effect on demand and supply dynamics. We're seeing some promising signs, but it's a dynamic situation.
So, for us listeners, what are some practical things we can do to protect ourselves or even thrive during inflationary times?
A few key strategies come to mind. First, review your budget and identify areas where you can cut back. Second, consider holding less cash and investing in assets that have historically performed well during inflation, such as certain types of stocks, real estate, or inflation-protected securities like TIPS, Treasury inflation-protected securities. Third, focus on increasing your income, whether through skill development, career advancement, or even a side hustle. And finally, manage your debt wisely, especially variable rate debt, as interest payments will increase. And that brings us to the end of another insightful episode of Money Matters. Inflation is a complex topic, but understanding its mechanics empowers you to make better financial decisions.
Those are really tangible tips. Alex, I know I'm definitely going to be looking at my budget more closely after this conversation.
Join us next time as we delve into another fascinating aspect of the financial world. Until then, keep learning and keep your money working for you.
See you next time.